Surprise, surprise. Folks, we've got another set of disappointing Q3 tech earnings. The latest culprit, Uber. The ride-hailing platform saw its stock crater nearly 11% by midday on Thursday, following the company releasing guidance that suggests that momentum may be slowing down in the company's growth, with the guidance failing to meet analysts' expectations. Folks, today I'm going to walk you through Uber's Q3 earnings. We're going to look at what people are saying online, what the analysts are saying, and what you should be paying attention to. Let's dive in. Now, that opening might be a little bit unfair to Uber. The company for the third quarter posted revenue of $11.2 billion, which was a 20% improvement over the $9.3 billion they recorded in Q3 of 2023. And they also beat analyst estimates of $11 billion. Which is an insane number when you consider that it is derived from people using their own vehicles as a taxi service via an app. Revenue could further be broken down into sales of $6.4 billion with the mobility segment and $3.5 billion in the delivery segment. The remaining $1.3 billion figure in revenue is attributed to the firm's freight segment. This revenue was derived from gross bookings of $41 billion, a 16% increase over the $35 billion in Q3 of 2023. This is also one area where the company failed to meet expectations, with analysts calling for gross bookings of $43.7 billion for the quarter. Mobility gross bookings totaled $21 billion, while delivery came in at $18.7 and freight came in at $1.3. Total trips climbed by 17% year over year to 2.9 billion, which averages out to 31 million trips a day, which is quite frankly mind-boggling. Income from operations grew by 169% on a year-over-year basis, jumping from $394 million to $1 billion. Net income came in at $2.6 billion versus $221 million last year. However, a massive $1.7 billion portion here of that net income is related to a one-time revaluation of equity investments, so it's heavily misleading. This, of course, impacted earnings per share, which came in at $1.20 per share versus analyst estimates of 41 cents per share. Adjusted EBITDA comparatively grew by 55%, moving from $966 million to $1.69 billion. Free cash flow also saw an improvement, climbing 133% from $905 million to $2.1 billion. Shares repurchased during the quarter totaled $375 million, or was it $372 million? Which sounds great, until you realize that stock-based compensation totaled a whopping $438 million over the 3-month period. The company ended the quarter with cash equivalents, and short-term investments of $9.1 billion. Aside from failing to meet gross bookings estimates, the other portion of Uber's earnings that failed to excite investors was their guidance. Uber is calling for gross bookings of between $42.75 billion to $44.25 billion in the fourth quarter, which is said to represent growth of between 16 to 20%. Uber also expects trips growth to be similar on a year-over-year basis to their performance in Q3, which for reference came in at 17% growth. On the adjusted EBITDA side of things, the company expects to post a figure within the range of $1.78 billion to $1.88 billion, representing growth between 39 and 47% year over year. Well, on a percentage basis, this growth sounds great. It evidently wasn't enough for analysts. On gross bookings, Uber's guidance midpoint of $43.55 billion was just shy of the $43.7 billion estimated by those analysts. Still in range, but lower than what the analysts wanted, nonetheless. On an adjusted EBITDA basis, analysts were right on the money with their estimate of $1.83 billion, matching Uber's midpoint. But the share price performance says that this wasn't enough. Now, let's just touch briefly on the operations of Uber during the quarter. Monthly active platform consumers reached 161 million during the quarter, a 13% year-over-year increase. And if you remember from earlier, trips on the platform grew 17% year-over-year to 2.9 billion. This, as a result, means that monthly active platform consumers are driving growth at Uber, with these users more frequently using the platform. Monthly trips per active platform consumers reached an all-time high this year, growing 4% on year to 5.9 trips per user. Ex-user Quality Invest 5 highlighted this trend in a tweet, summarizing it as the user base is using the services in higher frequency, which means there is still opportunity for growth for the company. Uber also highlighted during the quarter that drivers and couriers earned $18.1 billion in aggregate, including tips on the platform during Q3, a 14% improvement. In the same breath, however, they also indicated that they are focusing on expanding autonomous driving, starting in Austin and Atlanta, which basically means they want to cut out the middleman. Funds, meanwhile, seem to like this idea, with Kindred Ventures founder Steve Zhang going on the record on Thursday with Yahoo Finance, highlighting that the company stands to benefit from the explosion of autonomous vehicles and robo-taxis. The company is also placing an emphasis on growing their advertising business, with CEO Dara Khosrowshahi saying on the earnings call that they aim to get the segment to 2% of gross bookings. Advertising is currently sitting between 1 and 2% of gross bookings. So despite the strong growth, the market didn't like the results. The equity continued to sink even as we wrote the script for this video. Why the sell-off? Well, for one, the results were a bit mixed versus analysts' expectations, and for two, you'll go insane if you actually try to understand the market. Vocal investors, however, were quite happy with the results. B-Funk blamed the sell-off on the election despite liking the performance. Well, Quality Investing with Aria believes it's on the lower guidance, despite the strong quarter. And Market Wizard thinks it's simple. Only Nvidia is allowed to go up. Well, several others thought it was just simply a good quarter. So let's wrap it up. Tech has had a bit of a challenging third quarter in terms of market reaction, and Uber seems to be no exception to that rule. Despite strong growth, there wasn't enough for the markets, and here we are. Does that mean that there's a buying opportunity here? Perhaps, but what do I know? Zooming out a bit here, the company has built a platform that services 31 million trips a day. And many in the market see this figure and then they think about the rise of autonomous driving and they think that there's a home run opportunity here for the tech company to cut out the middleman. But what many are failing to consider here is that Uber is actually getting the upper hand in the current scenario. Do they need to pay out drivers? Sure, but take a step back here and realize what the drivers are actually being compensated. They often don't factor in the cost of the car or the wear and tear on their vehicle when they choose to serve as a de facto taxi. All they see is that they're making 15 or 20 bucks an hour and say, hey, this seems a lot better than working at McDonald's. If Uber suddenly has a fleet of vehicles they need to maintain, how's that going to impact profitability? Will their service fee sufficiently outsize wear and tear on vehicles, cleaning expenses, routine maintenance, or the fleet of employees that they're going to need to service these vehicles? If the answer to all that is yes, okay, then sure. But should a glorified taxi company then trade at a forward PE ratio of 33 times? Now, look, guys, that's up to you to decide. In the end, the companies who are first to market with autonomous driving may not even choose to work with Uber, but take on the tasks themselves because they can easily create their own app and they probably can already make cars at scale because they're an auto manufacturer, at least most of the companies that are involved with autonomous driving. So look, I've never understood Uber. I understand that they've already got the network, they've already got the stickiness on their platform, but their drivers aren't going to be worth anything in an autonomous world. And quite frankly, I don't see why General Motors or Google or Chrysler or you name it can't swoop in and compete with them the second that they actually have autonomous driving start to get approved across the country. All right, everybody, thank you for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section, guys. We are covering lots of different companies this earnings season. Let me know who you think we should be covering. Let me know what you think of Uber. Do you think that Uber's a good buy here? Do you think it's a good short? What are your thoughts? All right, everybody, thank you for watching.